Private equity funds have made billions buying companies, restructuring them, and selling them for massive gains. But what kind of company actually makes a great buyout candidate? That's exactly what we'll break down today, step by step. To understand this, you first need to know what an LBO, leveraged buyout, actually is. In an LBO, a private equity firm buys a company using a combination of equity and a significant amount of debt. Over time, the firm uses the company's cash flows to pay down that debt, and ideally, exits at a much higher valuation. The key idea is that debt amplifies returns. By financing the deal with borrowed money, the PE fund puts in less equity, so when the company's value increases, the equity holders get a much higher return. Think of it like buying a house with a mortgage. If the house value goes up, your equity return is multiplied. Because of this structure, not every company is a good candidate for an LBO. Private equity firms look for very specific characteristics to make sure the deal works financially and operationally. First, strong and predictable cash flows. Since debt is repaid using the company's own cash flows, stability and predictability are critical. PE funds want businesses with recurring revenue and low volatility. Second, low existing debt. If the target already has a lot of debt, there's less room to add new leverage, which reduces the attractiveness of the deal. Third, tangible assets or collateral. Assets like real estate, equipment, or receivables can help secure the LBO financing. Fourth, operational improvement potential. PE investors love finding companies they can streamline, scale, or make more profitable through better management and strategic changes. By the way, if you want to dive deeper into concepts like LBOs, valuation, and interview prep for investment banking, check out our free foundation course at thinksters.com. It's concise, practical, and designed for 2025 recruiting. Fifth, experienced management team. A capable leadership team ensures the company can execute the turnaround or growth plan envisioned by the PE fund. Sixth, favorable industry dynamics. Sectors with steady growth, low disruption risk, and consolidation opportunities are ideal. Finally, clear exit opportunities. PE firms need to know how they'll sell the company IPO, strategic buyer, or secondary buyout. If the exit path is unclear, the deal becomes much riskier. For public companies, identifying good LBO candidates involves screening for metrics like low existing leverage, stable EBITDA margins, high free cash flow conversion, undervalued stock relative to peers. For private companies, the focus shifts more toward operational characteristics, cash flow stability, and ownership willingness to sell. To summarize, a strong LBO candidate is a business with stable cash flows, low existing debt, tangible assets, operational upside, strong leadership, favorable industry dynamics, and a clear exit strategy. Private equity firms are laser-focused on these elements because leverage magnifies both upside and downside. If you want to fully master LBOs and the other core technicals you'll face in investment banking interviews, check out our free foundation course at thinksters.com. This is the exact knowledge base top candidates rely on to break into investment banking and private equity.